Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate jargon and financial wizardry. And guess what? Today we're diving into Cero Therapeutics Holdings Incorporated's latest proxy statement. It is a doozy, packed with some big decisions the company wants its shareholders to weigh in on. Think of it as a shareholders town hall, but in document form. Before we jump in, if you are not already subscribed and you want more of these straight to the point breakdowns, do yourself a favor and hit that subscribe button. And hey, join our Discord community linked in the description where we chat about all things business and finance. So, Cero Therapeutics Holdings Incorporated is calling a special meeting of its stockholders. They want to talk about a few really important things, like potentially changing how their stock looks, dealing with some NASDAQ issues, and sprucing up their employee stock plan. Let's break down what that actually means for the company, and for you if you own any Cero stock. This special meeting is scheduled for the 19th of December 2025, and it is going to be held online, which is pretty standard these days. You can attend, ask questions, and vote all from your computer. First up, they want to do a reverse stock split. Now, what is that exactly? Imagine you have 10 $1 bills, and the bank exchanges them for one $10 bill. It is kind of like that, but with company stock, they are talking about combining a bunch of shares into a smaller number of shares. The ratio could be anywhere from 1 for 40 all the way up to 1 for 150. Why would they do this? Well, the filing mentions they received a determination to deny their request to continue listing their common stock on NASDAQ. Their stock price has dropped significantly, and a reverse stock split is often done to try and boost the per share price. The hope is that a higher stock price might make their stock more attractive to investors and potentially help them get back on NASDAQ. It is a tricky move though, because sometimes a reverse split doesn't actually fix the underlying problems, and the stock price can keep falling. They are very clear that there is no guarantee this will boost the stock price. And it might even make things worse for liquidity, which is how easily you can buy or sell shares. The company specifically mentions that on the 29th of October 2025, they received a ruling from the NASDAQ hearings panel to deny their request to keep their stock on NASDAQ. Their shares then started trading on the OTC pink sheets. They admit the closing bid price on the 12th of November 2025 was just over 9 cents per share. That is definitely not a NASDAQ friendly price. The goal here is to get back up above $1 per share, the minimum requirement for NASDAQ. They're worried that the reverse split might not actually increase the stock price. They point out that their stock price has gone down after previous splits. There is also the risk that even if they regain a NASDAQ listing, they might not be able to meet other ongoing requirements, like the minimum stockholders' equity. It is a bit of a gamble to try and fix a low stock price this way, and they even acknowledge that the board could decide not to go through with it, even if shareholders approve it. Let's look at some numbers here in the table. If they choose a 1 for 40 split, with about 20.8 million shares outstanding right now, that would leave them with just over 520,000 shares. If they go for a 1 for negative 150 split, that number drops to under 140,000 shares. This means each share would represent a much bigger piece of the company. But you'd own fewer shares. Next up is proposal number 2, the NASDAQ stock issuance Series E proposal. This is a bit technical, but basically they issued some preferred stock called Series E back in October. Now, because of how this preferred stock works, particularly when it can be converted into common stock, and a rule on NASDAQ that requires stockholder approval for certain stock issuances, they need your okay to issue more shares. NASDAQ listing rule 5635 is the key here, and it relates to getting shareholder approval before issuing stock that could lead to a change of control, or if the price is below the minimum price. If this proposal is not approved, they could have trouble raising money in the future, which they say could force them to liquidate or seek bankruptcy protection. That is a pretty stark warning. This section talks about how the conversion price of the Series E preferred stock can be adjusted. If the stock price goes down, the conversion price can also go down, meaning more shares could be issued. They are worried that if certain triggering events happen, like a failure to maintain NASDAQ listing or other defaults, the Series E preferred stock could convert at a much lower price. In a worst case scenario, they describe, the holders of Series E could end up owning over 30% of the company's common stock. If approved, existing shareholders will see their ownership diluted. If not approved, the company might not be able to raise needed funds and could face serious financial trouble. It is a clear choice between dilution and potential financial ruin, which is a tough spot for any company to be in. Proposal number 3 is about increasing the number of shares available under their 2024 equity incentive plan. This is essentially a way to give more stock options or awards to employees and executives. They want to add another 32 million shares. The company believes this is necessary to attract and retain key talent, especially as they advance their drug development and potentially secure new funding. They've also got an evergreen provision in the plan that automatically increases the share pool each year. In trying to figure out how many shares to add, they looked at how many equity awards they've given out, how many are left, and how many they think they'll need in the near future. They mentioned needing to recruit a new CEO, and that as their drug candidate Cero-1236 moves into clinical development, they'll likely need to raise more money. Equity compensation is a big part of their strategy to incentivize people. Looking at the table here, Chris Ehrlich, the CEO, has been granted a good number of stock options. Other executives and directors also have stock options. This is standard practice to align employee interests with shareholders. The big takeaway here is that they see equity as a crucial tool for growth and retention. Finally, proposal number 4 is an adjournment proposal. This is a fallback option. If the stockholders don't vote enough, yes votes for proposals 1, 2, or 3, the company can propose to postpone the meeting. This is so they can try to get more shareholder support. It is basically giving them the option to extend the decision-making process if things don't go their way initially. Now, let's talk a bit about the company's stock itself. They are authorized to issue a lot of common stock and preferred stock. As of the 14th of November 2025, they had a significant amount of common stock outstanding, but also quite a bit of preferred stock, like Series A, C, D, and E. These preferred stocks have different conversion rights and terms, and they do play a role in how much dilution potential shareholders face. Specifically for Series E, it was issued in October and has some complex conversion terms. If the company has triggering events, or if they issue stock below certain prices, the conversion price can go down, meaning more shares could be issued to these preferred stockholders, which dilutes common stockholders. They are very upfront that approval could dilute existing shareholders, but not approving it could lead to severe financial problems and potentially bankruptcy. They also mention public warrants. These are essentially options to buy stock at a certain price. Some of these warrants can be redeemed by the company, and they have specific conditions for that, like the stock price needing to be really high for a sustained period. They also have anti-dilution adjustments, meaning the terms can change if the company issues more stock or splits its stock. Looking into related party transactions, we see a few notable items. Daniel Corey, who was a former CEO and board member, bought some series of preferred stock. Brian Atwood, another director, also purchased preferred stock and warrants. These are situations where insiders are involved in the company's financial dealings. The company has policies to review these to avoid conflicts of interest. This table shows who owns what. It lists major shareholders and the company's directors and executive officers. You can see the ownership stakes, and it is important to note that this percentage ownership includes shares that could be acquired through options or warrants within 60 days. Chris Ehrlich, the CEO, has a small but direct ownership stake. Brian Atwood, a director, also has a notable stake, including shares through a trust. Now let's put on our Warren Buffett hat and analyze this. Cero Therapeutics is in a very tough spot. They are trying to navigate significant financial challenges, evidenced by their stock's removal from NASDAQ and the low trading price. The reverse stock split is a Hail Mary pass to try and regain NASDAQ listing, but as they themselves admit, it might not work and could even hurt liquidity. Proposal 2, the NASDAQ Issuance Series E proposal, highlights a classic dilemma. Dilute existing shareholders to potentially secure future financing and avoid bankruptcy, or refuse dilution and risk the company's survival. The fact that they mention liquidation or bankruptcy if this isn't approved is a massive red flag. Proposal 3, the stock plan increase, while standard for growth companies, is happening at a time when the company's financial health is precarious. It shows they're still planning for the future, but the success of these plans heavily depends on their ability to overcome the immediate financial hurdles. The preferred stock and warrant structures create significant potential dilution for common shareholders, and the terms are complex, often favoring the preferred holders in adverse scenarios. The company's direction seems to be focused on survival and regrowth, with a clear need to regain a national exchange listing. The strengths lie in their stated plans for drug development, but the weaknesses are glaringly obvious in their financial situation and the NASDAQ delisting. The biggest risks are the failure of the reverse stock split to boost their stock price, the potential for massive dilution from preferred stock conversion, and the very real possibility of running out of cash. An opportunity would be if their drug development pans out, but that is a long shot with their current financial footing. In conclusion, Cero Therapeutics is in a challenging situation, facing critical decisions at this special meeting. While they are trying to set themselves up for future success through stock plans and potential NASDAQ relisting, The immediate financial risks are significant. Their survival hinges on gaining shareholder approval for these proposals, which carry both potential benefits and substantial risks of dilution and uncertainty. Alright, that is our breakdown of Cero Therapeutics Holdings Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.